Crypto banking and decentralized finance. Here's what is happening in the fast growing crypto finance industry, a sector that has officials in Washington sounding alarm bells. The development of Bitcoin and thousands of other cryptocurrencies in a little over a decade has changed the definition of money and spawned a parallel universe of alternative financial services, allowing crypto business to move into traditional banking territory. Here's what is happening in the fast growing crypto finance industry, a sector that has officials in Washington sounding alarm bells. What alternative banking services do crypto business offer? Most notably, lending and borrowing. Investors can earn interest on their holdings of digital currencies, often a lot more than they could on cash deposits in a bank, or borrow with crypto as collateral to bank a loan. Crypto loans generally involve no credit checks as transactions are backed by digital assets. Who is in this sector? The market is quickly being flooded with businesses from vaguely familiar to science fiction like entities. They run the gamut from BlockFi, which offers interest bearing accounts like a bank and has a state lender licenses, and the Karken Bank, which was granted a worming bank charter and hopes to soon take retail deposits to markets controlled by computer code and devised to be governed by users through a token distribution structure. Compound, a decentralized automated lending and borrowing system, began in 2018 and now has more than 18 billion in assets earning interest. How do crypto offerings differ from bank services? Superficially, some look similar. Take the BlockFi interest account, where consumers deposit cash or crypto and earn monthly interest as if at a bank. But one big difference is the interest rate. Depositors can earn a yield more than 100 times higher on BlockFi than on average bank accounts. Those rewards come with risk. Deposits are not guaranteed by the Federal Deposit Insurance Corp. Cyber attacks, extreme market conditions, or other operational or technical difficulties could lead to a temporary or permanent halt on withdrawals or transfers. The company cautions in the fine print. Some regulators and lawmakers worry that those warnings are not prominent enough and that consumers need stronger protections. Why such high yields? Traditional banks lend out their customers deposits and pay clients a slice of the earnings as interest. Crypto outfits take a similar approach. They pool deposits to offer loans and give interest to depositors. But by law, banks are required to have reserves to ensure that even if some loans go bad, customers can still withdraw funds. Whereas crypto banks do not have the same reserve requirement and the institutions they lend to can take risky bets. BlockFi, for example, lends to hedge funds and other institutional investors who exploit flaws in crypto markets to make fast money without actually holding risky assets, betting on discrepancies between actual crypto values and crypto futures. When successfully, their speculations generate returns that help fuel the higher riskier consumer yields. What is stablecoin? Crypto is very volatile, making it less practical for transactions like payments or loans. That's where stable coins come in. They are cryptocurrencies pegged to stable assets, commonly the dollar. They are meant to provide the steady value of government issued money in digital form for blockchain transaction, but they are issued by private entities. Popular dollar-tied tokens include Ether and USD coins. The number of stable coins in circulation globally has jumped from 29 billion in January to 117 billion as of early September, according to the Block, a publication dedicated to cryptocurrency. To keep the value of government issued money stable, central bankers manage supply and demand and ensure that there are ample reserves. Stablecoin issuers are supposed to similarly hold and monitor reserves, but there is no guarantee they actually hold the one-to-one dollar backing they claim. Some authorities fear a sudden surge in withdrawals could lead to collapse in one of those assets, putting consumers, financial companies, and possibly the broader economy at risk. Others suggest a central bank digital currency would render stable coins irrelevant. What is a central bank digital currency? Central bankers are examining the potential for issuance of government issued cryptocurrency that would theoretically offer the convenience of crypto within the reliability of money controlled by a central bank. Many countries, including the United States, are considering developing a central bank digital currency because a stablecoin aims to do digital form that government money does. Provide a stable value, a US digital dollar could undermine the private money minters of the cryptosphere. You wouldn't need stable coins. You wouldn't need cryptocurrencies. If you had digital US currency, I think that's one of the stronger arguments in its favor. The chair of the Federal Reserve, Jerome H. Powell, said in July. Stable coin issue says the government will not catch up to the innovations in the market for years, if at all. Meanwhile, the system will become more dependent on stable coins. It is unclear whether markets awash in those assets will abandon them altogether for a potential Fed coin. What is DeFi? Decentralized finance, or DeFi loosely describes an alternative finance ecosystem where consumers transfer, trade, borrow, and lend cryptocurrency theoretically independently of traditional financial institutions and the regulatory structures that have been built around Wall Street and banking. The DeFi movement aims to intermediate finance using computer code to eliminate the need for trust and middlemen from transactions. Practically speaking, users are not engaging with a financial services company, at least not one that collects identifying information or claims custody of their assets. It's computer control market that automatically executes transactions like issuing loans backed by crypto or paying interest on holdings. DeFi platforms are structured to become independent from their developers and backers over time and to ultimately be governed by a community of users whose power comes from holding the protocol's tokens. By comparison, centralized finance or CeFi business more closely resemble traditional finance or TradeFi, where consumers enter into an agreement with a company called BlockFi that collects information about them, requires them to turn over their crypto, and also serve as a central point for regulators. Thank you.